You're driving to work. Regular Tuesday. Nothing weird. Then your car makes a sound you've never heard before. You pull over. You already know this isn't going to be cheap. You just don't know how bad it is yet. The mechanic says $4,200. Your transmission is shot. You stand there nodding like you understand what that means. You don't. All you know is the number, $4,200. Your savings account has $300 in it. Maybe. But it gets worse. That same week, your landlord sends a notice. Rent's going up $200 starting next month. Oh, and your dog needs emergency surgery. $3,800. You're now staring at roughly $8,200 in costs you didn't plan for, with $300 to your name. This happens to people every day. According to Bankrate's 2026 report, 59% of Americans can't cover a $1,000 emergency without going into debt. You're not dealing with $1,000. You're dealing with 10 times that. 1 in 4 Americans has zero emergency savings. Nothing. Not a dollar. The median emergency fund in America right now is $5,000. Half the country has less than that. So if a $10,000 emergency hits you, you're not unlucky. You're average. Option 1, credit cards. The one everyone reaches for first. You slap the $4,200 repair on your Visa. The vet bill goes on your MasterCard. Feels manageable. You'll deal with it later. That's what everyone says. Here's what later looks like. The average credit card interest rate right now is about 22%. That $8,200 on your cards, if you pay the minimum every month, you're looking at about 14 years to pay it off. The total you'll hand over? Somewhere around $16,000. You borrowed $8,200. You paid back double. That's what minimum payments do. They don't help you. They help the bank. Option 2, personal loan. You go to a bank or an online lender and ask for $10,000 to cover everything plus some breathing room. If your credit score is decent, around 700, you're looking at roughly 12% interest on a 3-year loan. Monthly payment comes out to about $332. Total cost when you're done? Around $11,950. You overpaid by about $2,000 in interest. Not great, but compared to the credit card path, you just saved yourself $4,000 and 11 years. But here's the catch with personal loans. You need a credit score to get one. If you're sitting at 580, your interest rate jumps to 22% or more. Suddenly, the personal loan costs the same as the credit card. And if your score is below 550, most banks won't even talk to you. The people who need help the most get the worst options. That's how the system works. Option 3, the one nobody should ever take but millions do anyway. Payday loans. 12 million Americans use them every year. The pitch sounds simple. Borrow a few hundred, pay it back on your next payday. The fee is just $15 per $100. Sounds reasonable. It's not. That $15 per $100 on a 2-week loan works out to an annual interest rate of 391%. That's not a typo. 391%. And 80% of people who take a payday loan can't pay it back on time, so they roll it over. New fees stack on top. A $500 payday loan can end up costing you over $1,500 if you roll it 3 or 4 times. The average payday borrower takes 5 months to pay off what was supposed to be a 2-week loan. Option 4, borrow from family. No interest, no credit check, no paperwork. Sounds perfect, and sometimes it is. But there's a cost that doesn't show up on a spreadsheet. The relationship changes. The next family dinner feels different. Every purchase you make, they're watching. That vacation photo you posted, they noticed. The math is free. The emotional tax is not. Option 5, negotiate. Most people don't know this, but you can call the mechanic, the hospital, the vet, and ask for a payment plan. Most will say yes. Some will knock 10 to 20% off the bill if you offer to pay a lump sum, even a partial one. Hospitals especially. Medical debt is negotiable, almost always. But nobody tells you that, because the system makes more money when you don't ask. Option 6, sell stuff. Your TV, your gaming console, that bike collecting dust, clothes you haven't worn in a year. It won't cover $10,000, but it might cover $1,000 to $2,000, which reduces the amount you need to borrow and the interest you'll pay on the rest. $1,000 less on a credit card at 22% saves you over $1,200 in interest over time. Every dollar you don't borrow is a dollar that doesn't multiply against you. Let's say you went the credit card route. It's been 6 months. You've been paying minimums, $180 a month. Your balance has barely moved. It's gone from $8,200 to $7,900. You've paid over $1,000 and knocked off $300. That's 6 months of payments and almost nothing to show for it. You're not paying off debt, you're renting it.
Now let's say you took the personal loan. Same 6 months. You've paid about $2,000 total. Your balance is down to $6,400. You can actually see progress. You have a finish line. 30 months away, but it exists. That's the difference between a plan and a trap. One has an end date, the other just keeps going. And the payday loan person? 6 months in, they've paid more in fees than the original amount they borrowed. They've taken out 4 more payday loans to cover the first one. They owe more now than they did on day one. They're not in a hole, they're in a tunnel that keeps getting longer. A $10,000 emergency isn't rare. Cars break, bodies break, life breaks. The question was never if it would happen. It was always how much it would cost you when it did. And the answer depends entirely on what you do in the first 48 hours after it hits. The wrong move costs you double. The right move still hurts, but it ends. If you're watching this and you don't have $10,000 saved, welcome to the majority. You've got company. But now you know what each door actually costs before you walk through it. And that's worth more than most people have when the call from the mechanic comes.